You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, let's jump right into it. We are getting into the heart of earnings season. That is, if you are a tech person and you think the heart of earnings season is when all the tech companies are announcing earnings. We have to go back and look at what we did last week. And I'm going to keep the theme from last week. We actually looked at McDonald's, which was going to be announcing earnings next week. And we said, well, let's do a trade that avoids earnings, that is a time decay trade. And I should let you know that we are taping Options Playbook Radio. It's Wednesday, January 22nd. The markets are closed right now. And we're looking at McDonald's from last week, and we're going to look at where McDonald's is currently trading at. So if we pull up a quote on McDonald's right now, we see it trading at $211.44. So that's $211.44. It is up 28 cents on the day. And the strategy that we did last week was a butterfly. And we specifically knew that McDonald's was going to be announcing earnings on the 29th. So we decided to do this butterfly on the expiration prior to the 29th. That would be the 24th expiration. So in that instance, the January 24th option contracts will be expiring on this Friday. And the trade that we did was just a 5-point wide trade in McDonald's. We went in and looked at buying that expiration. We bought the 205 strike call. We sold 2 of the 210 strike calls, and we bought 1 of the 215 strike calls. The stock on that day was at $209.77, and it was actually up $2.45, which was a fairly decent percentage move in McDonald's, just in general, on a kind of a no major news day. So with that being said, the stock was very close to the middle strike. And what we're kind of demonstrating is that if you're doing a butterfly on a medium price stock, like a $209 stock, like McDonald's is, we are just looking to try to get some time decay. We're just saying, well, the stock has been a little bit volatile lately. We're going to be coming into earnings. Our forecast is that volatility will settle down and that the stock will stay somewhere between 205 and 215. So that was our goal. Butterflies, if you are correct on your forecast, appreciate time decay. They prefer that time decay on the option contracts that you sold goes away, because our best bet is that right at expiration, that McDonald's would be trading right at the middle strike, the strike that we sold at $210, and we need that middle strike to be trading for as little as possible because we'd have to buy them back to close out the position. So at expiration, if it's right at 210, in theory, this should be trading for zero. You can buy and close those for zero. You sell the wings of the option contract, and hence the maximum we can make is $5 in this scenario. So what has McDonald's done since we put the trade on? Well, it's basically stayed kind of flat. We put this trade on the 15th, which was last Wednesday is when that would have been. And on that day, as I said, it closed very close to 210. And since that time, it's just kind of fluttered around. It was up a little bit, up a point, got up to about 212, came back down, and now as of today, it closed at 211.44. That's the closing price as of Wednesday, the 22nd of January. So when we're looking at butterflies, where the pricing is, it's kind of tough to guess exactly how time will decay over time. So as usual with Options Playbook Radio, we're just trying to learn. These aren't meant to be recommendations because we're doing a whole plethora of different strategies, and we're just kind of looking for stocks that might match the strategy. We're not necessarily making a forecast on the stock. And with McDonald's, so this has worked out so far. The trade hasn't moved outside of the wings, so there was really no reason to get out of it. And by outside of the wings, I mean below the 205 strike call that we bought or above the 215 strike call that we sold. And so if I pull up a quote on the butterfly that we looked at last week, the maximum that it could trade for is $5. And we see that right now at the midpoint, that same butterfly with a couple days remaining to expiration, 2 full trading days, is trading for $2.91. So on this trade, we're up about 50 cents. And that's a good trade on a butterfly. You pay $2.38. You're up 50 cents. It's well over 20% in the account. So you just get out of the trade. You don't try to hang around. And I think that's the moral to the story with the butterfly. You're very rarely trying to hit a home run. And as a matter of fact, if you did hit a home run and it went out right at 210 on expiration, you should really receive the stupid award for that because you should have been out of the trade earlier. You shouldn't be hanging around hoping that I'm just going to hit the maximum and hit the lottery on this type of trade. You want to take your profits when they're around. That's a very low-risk trade. We got the defined risk of $2.38 when we put on that trade if we were to fill in the midpoint. And we know that if it's on what range we need the stock to stay within, and it's a 10-point range in this instance from 205 to 215. And in a week's time, we were going to get out of this trade anyways. We just, for the same reason that we don't want to ride it all the way to expiration, we don't want to miss out on that opportunity if we are even correct on our forecast. It's the same reason why if we're incorrect, we want to get out of the trade. Because if we go all the way to expiration and the stock actually moves outside of our wings, our bought option contracts, well, there's going to be nothing to close. There's going to be nothing to sell. So we're just going to manage our risk that way. So that butterfly has worked out. It's up 53 cents on a $2.38 investment, or $53 on a $238 trade overall, and we move on to the next trade. So I'm going to keep this theme. I kind of like the concept of learning about volatility not around earnings. We've been looking in Options Playbook Radio, if you go back to all the earnings trades that we've done, a lot of them are trying to take advantage of the volatility crunch after earnings, kind of knowing that volatility will probably come in once that event is announced and the stock has already made the move. So in this instance, though, we were trying to do something where we knew that, oh yeah, volatility isn't quite that high right now on the expiration prior to it, but then again, we don't actually expect it to take off because people are going to wait around for earnings and wait for that announcement. Now, what really helped us in the McDonald's trade is that it was a fairly high-priced stock. At $210 means we're getting some premium just because the underlying stock, not necessarily the fact that it's volatile, but the underlying stock is $210. it's a fairly expensive stock, and the more expensive the underlying, the more expensive the option premium is going to be, specifically on the at-the-money option contract where all the juice is at. So sometimes it makes sense in certain situations to do a butterfly where you're selling two at-the-money option contracts, knowing that at expiration, they got to go away. If I'm correct on my forecast, the value of those option contracts have to come in. Time has to decay from them. All right, so we're going to look at the same scenario. Disney has had a big run-up. It's pretty much the same type of story with McDonald's of last week. But the big news with Disney is they came out with their streaming service called Disney Plus. And the stock has ran up quite a bit because they have blown away subscribership, and they've announced big numbers, almost triple what they were expecting. And because of that, they had a big run-up in their underlying stock. But that had nothing to do with earnings. So once again, we have February 4th anticipated earnings date in Disney. So we got some time here. Next week, we're going to come back and we're going to look at some of the volatility trades because we got a lot of the FANG stocks that are going to be announcing earnings, Amazon, Facebook, etc. So we're going to look at this trade leading into that. And we're going to try to take advantage of the fact that, once again, Disney is a fairly high-priced stock. Today it closed at $144.01. It's up 45 cents today, or $144. And we're going to look at the expiration that does not contain the earnings. So the closest expiration that does not contain the earnings is the January 31 expiration date on Disney. And we're going to do an iron condor. So instead of doing the butterfly, which we did last week to try to take advantage of time decay, we're going to give ourselves a wider sweet spot, and we're going to use the expiration that does not contain the earnings. And the difference in implied volatility, just for sake, is that the at-the-money vol with the January 31st expiration, 9 days away, is trading for a 19% implied. We go to February 7th, 16 days away, that does contain the earnings. That's at a 31% implied. So we are still selling some decent juice. 20% implied volatility on a $144 stock is not bad overall. And we expect, once again, that would probably go lower as we head into earnings, just waiting for the big announcement. And a lot of people will be very interested in what happens with Disney. But we're going to try to take advantage of the fact that nobody's looking at it right now because they're not going to announce earnings till February 4th. All right, so the setup for our iron condor is to use the January 31st expiration, 9 days away. We're going to sell 4 points below the 140 put. We're going to then also sell 4 points above the 148 call, and then we're going to buy the wings. We're going to only go 2 points wide, so we're going to be buying on the put side the 138 strike put, and we're going to be buying on the call side the 150 strike put. So the strikes that we are using, we're doing 138, 140, 148, 150, all the January 31st expiration. Now, we can get this done for a net credit at the midpoint of 45 cents. So we're not going that wide, and we only have 9 days remaining to expiration, but we can still get a decent credit, 45 cents on this account. And the big reason why we're able to pull in an okay credit here is the fact that we're selling two spreads, right? We're selling a put spread that wants the market to go up, and we're selling a call spread that wants the market to go down. So if we do this trade, our sweet spot is much bigger than it was with the butterfly. We're looking at an 8-point wide sweet spot from 140 all the way up to 148. So that gives us a wider range that we can actually make the maximum profit on. So when we were doing the butterfly trade, we needed it to go right to 210, and we needed it to just stop. So my approach on the butterfly trade is, well, if it's around 210 and there's a couple of days of expiration, we're just going to get out of the trade. We're going to take whatever profit we got, and we're going to move on. If we're looking at the iron condor, yeah, you can buy it back if you want to close out one side, one spread versus the other spread because one's out of the money, and et cetera, et cetera. That's okay. But I don't mind allowing this one to ride all the way to expiration because we don't need it to stop at a specific point. So it's just a different mindset by doing the iron condor. Now, it's approximately the same amount of risk. In the McDonald's trade, we played $2.38 for that McDonald's trade, but in this instance, we're doing a 2-point wide spread. So our margin requirement is going to be that 2 points, but we can use the credit to help pay for it. So since we receive that credit right away, if we use that to pay for the trade, our max risk here is going to be $1.57. So we're looking to make 43 cents, and the maximum that we can lose is $1.57 on the trade. We have a much wider sweet spot. We have an 8-point sweet spot that this could be in at expiration, and then all the option contracts would expire worthless. We would be able to receive that net credit in the account. And most of the time, if I'm doing a trade like this around a specific event, right, we're doing it because earnings is the week after that, and we're just looking for Disney to kind of settle down and trade much like McDonald's did last week, going up into that earnings. And if I'm doing that, I don't mind letting this ride all the way to expiration if I can. But just like the butterfly from last week, if it gets outside of our range, in other words, on the downside, we bought the 138 strike put. If it gets down to 138, I'm getting out of the trade. I don't want it to continue on down. If it's an at-the-money option contract that I'll be selling, there might be some juice in it, so that helps protect me a little bit. Also on the upside, if it goes up to the 150 call, I'm going to get out of that trade. Now, hopefully it doesn't happen right at expiration, and it kind of benefits me that it's an at-the-money option contract. Or you can approach it this way and say, well, I did this for a 45-cent net credit to the account, so if this thing trades anywhere around 90 cents, I will buy to close the entire position, pay that 90 cents, and basically lose 45 cents on the trade. So you can look at it as the way that the underlying stock is moving, or you can go on out and say, well, I'm going to cap my net loss, and if I could make 45 cents here, I'm not going to allow myself to lose more than 45 cents. And one of the nice benefits of doing this outside of earnings is that you're most likely not going to have a gap on the opening. That's not going to allow you to trade out of this. Now, news events could happen. They happen all the time. That can blindside you. But in general, if it's just normal trading leading into earnings, these are interesting periods to do trades that want to take advantage of time decay. Hence, the butterfly in McDonald's last week and the iron condor in Disney this week. All right. That's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.